Welcome to Chapter 3. We're going to continue our look at asset and stock acquisitions and combinations by now focusing on what happens on the parent's books when it's a stock acquisition and we have an investment account. The parent records that investment because they didn't acquire all of the underlying assets like Chapter 1, just an investment in the stock. So they debit an investment account on their general ledger and have that as an asset. Well, how do they account for that asset? There's three options they can use to account for that asset. The way your text defines them is the cost method, the simple equity method, and the sophisticated equity method. Cost and equity methods are common terms throughout the industry. Whether you define it as simple and sophisticated equity may vary, the terms just slightly, but the concepts are the same. So let's look at those three possibilities using problem 3.1. And we look here and see that they are acquiring an 80% interest. So that's what we're concerned with to start off with, is the 80% interest. And just like we had earlier, we know that we have to consider the price paid. The price paid here was by issuing 10,000 shares of stock that had a $70 market value. So the total price paid was $700,000. And just like we did in Chapter 2, we're going to use those circumstances to imply the full company value in this case. So that 875 is our starting point. We compare that, just like we did in Chapter 2, to the equity accounts of the subsidiary that we have acquired stock in. And we see in this case that there was total underlying book value of $550 for the 80% interest that was acquired. And we're going to then allocate that $550 to the two pieces that we saw in our Chapter 2 work as well. So we're going to allocate 20% to the non-controlling interest and 80% to the parent, and the total is still our basis for determining the excess. So the total excess here that has to be assigned is 325. Of that excess, 260 belongs to the parent and 65 to the sub. And we know from Chapter 2 that these two amounts are going to show up in the worksheet D entry. In this case, in reading through the problem, we see that there were two items at the date of acquisition that had a value different than book value. One was the land, so we need to adjust the land for $60,000. The other was the building for $120,000, leaving goodwill then of $145. And again, if we sum those, we see that we have allocated the full excess, which is obviously our goal. So that's the basic DDE, exactly like what we did in Chapter 2. Now we're going to look and shift gears. You'll notice I've highlighted in yellow. What we're looking at now is the actual parent general ledger entries. So we're away from the worksheet at the moment. We're actually focusing on the general ledger. So in all cases, regardless of which method was used, the parent has to record that initial investment. And remember, the investment was based on 10,000 shares that were issued at 70 with a $10 par. So that 700,000 split between par and paid in capital is the same all the way across. It does not differ between the alternatives. So that first entry looks identical. What changes then is from there forward. Under the cost method, the only thing that ever changes the investment is if you actually sell your stock or add more. So nothing changes the investment account at all here. The investment account will remain on the books at a balance of $700,000. Under the simple equity method, which is the method we're going to focus on the most and is used the most frequently in industry, the shift is to equate for the investment as its corresponding changes in the sub's retained earnings happen. Those changes should also happen in the investment account. And some of this you should have seen when you did the equity method in intermediate accounting. So whenever the sub retained earnings changes, there should be a corresponding change. Well, we know the two primary things that are going to change retained earnings would be income and dividends. And so that's what's going to impact the simple equity method. For the sophisticated equity, the same two things change the investment account, sub income and sub dividends. But what makes it sophisticated versus simple is we also account for the amortization of these excesses. Now in Chapter 2, no time had passed, so we hadn't talked about the fact that over time these items have to amortize or be written off. In our example here, land obviously we know does not depreciate, and goodwill, being an indefinite intangible, does not have a useful life. So those two we don't have to worry about. But the building we do, and it's given in the problem that the building had a useful life or remaining life of 20 years. So every year, as part of our worksheet or part of the sophisticated equity method, depending on which method is used, we need to account for that $6,000 change in the building, allocating it from the capital account to the income statement. So that will be the difference between our simple and sophisticated, is this $6,000. So let's go through and actually record the entries then. So if you look in the top of page 183, you see a summary of what happened in the sub Sauder's retained earnings. So for 2011, which is the year that we're in right now, they earned income of $60,000. Well, of that $60,000, the parent is entitled to 80%. So we're going to record an entry on the parent's general ledger, increasing the investment account and recording income, and that income is on the income statement of just the parent. And that's what the simple entry there. Okay, now how does that entry change if it's sophisticated equity? Well, we take the same starting point of $48,000, but then we're going to subtract our $6,000 amortization for the building that we recognized up above at our 80% ownership, and the entry under sophisticated equity becomes $43,200. And there is no entry for the cost method. Now when dividends are paid, actual dividends come in, we see that Sauder, the sub here, paid $10,000. Well, again, as the parent owning 80%, the parent's going to get $8,000 of that. And under the equity method, we record the cash coming in, but we reduce the investment, because if the underlying equity has reduced, then the investment should reduce. So you'll see that that direct relationship between equity and the investment holds true. Income's going to increase equity, increases the investment. Dividends decrease equity, they decrease the investment account. And you'll notice that entry does not differ between simple and sophisticated. It's only the income entry. Now under the cost method, we don't record the dividends as part of the investment. Instead, you'll notice that I have a separate entry written out for dividend income, because again, we don't change the investment account at all under the cost method. We only have to record the dividend income itself. So how does that make what does that make our investment account look like? Well, here our investment account is going to be still at $700,000. It remains at $700,000 until actual shares are bought or sold. Here we added in our income less amortizations, less dividends. Our ending balance under sophisticated equity should be $735,200. Under simple equity, we add in income because that increases the investment, subtract out dividends, and our ending balance under the simple equity method is $740,000. Now that's the starting point, or that's the parent's general ledger. Now when you go to do the consolidation, you're going to see on the parent's trial balance one of these three methods, or one of those three amounts based on the method that was used. The method used does impact then the worksheet entries, because we do have to alter what happened on the worksheet. So let's skip down for a minute. We'll come back to 2012 and come down to the 2011 worksheet entries that we see here, okay, and under each method. Well, as we're going to see in our next exercises, and you should have seen in your reading, the CY1 entry goes towards that issue of subsidiary income that was recorded by the parent, and it reverses exactly the entry that was made up above. So all I'm going to do here is reverse what happened, because remember, this is a parent entry recording something that happened within the single economic entity, not with an outside party. So when I get to the worksheet, I have to eliminate it. Now for the CY2 entry, that regards the dividends. This one's a little bit different. It's not a pure reversal, because you'll notice part of the entry there is cash. Well, cash is cash. We're not going to reverse out cash. But if you think about it, while the parent recorded a change in the investment that we're going to eliminate, the sub also recorded dividends. Well, those dividends were not paid to an outside party, so again, those have to be eliminated. The elimination then on the cost method goes through the dividends declared, but not through the investment. You still have to eliminate the dividends declared on the sub, but the debit there, which we'll put over here in blue, is the dividend income that we recognized on the parent's general ledger. So that's how we take into account those items for CY1 and CY2. Now when it comes to the other entries, I don't have them all written out here, but you'll notice that at the bottom I did make you some notations. The EL entry is not impacted by the investment method that's used, but the D and the A method are. And the difference comes in solely between the simple and sophisticated equity method and the amortizations. Because if we're using sophisticated equity, then the amortizations become part of the actual general ledger and are not needed on the worksheet, and that's the primary difference. Now let's try the same thing for 2012. If we look at 2012, we see that the sub underlying had income of $50,000, so $40,000 of that belongs to the parent. Again, the same amount less 80% of the amortization is what we record under sophisticated, and there's no adjustment under the cost method. Then again, for our dividend, it's going to be the same as the prior year, 80% of the $10,000 that was paid. And under the cost method, we record it as dividend income, not a change to the investment. So that's what happens in all of those. And again, then if we update our account balance in the investment, here it's $700,000. Here again, we're going to have less addition because we subtracted out the amortization. And under simple equity, which is the method we'll use the most, there is always a direct correlation between the underlying retained earnings and the investment account. So those are your ending investment balances. Now let's go back to the worksheet and just do one more time to clarify the 2012 entries because there is one difference here in terms of a CV entry. Under the cost method, after the first year everything is still part of the initial trial balance, but after the first year you've had some income close to retained earnings. So that cumulative effect to retained earnings ends up being, if you will, a catch-up entry under the cost method. So if the cost method is used, that requires a CV or conversion entry at the beginning of the year, and in this case it's going to be a $40,000 entry. And you would calculate that by looking again at the underlying change in the subsidiary's retained earnings and taking your ownership, in this case 80%. The other way you can see it here, because we have it all laid out, is you're basically converting it back to the cost method. Okay, I'm putting into the investment account the $40,000 that I would have done under the simple equity method. And that's what your catch-up or CV entry is. And then you can proceed from there so that your EL entry, as we noted down below, is exactly the same because you've caught it up, the investment account up to the exact same point in time. Our other eliminations then just mirror what we had up above. So if we had 40,000, we now eliminate that and we eliminate the 8,000 in dividends. Under sophisticated equity, we're going to eliminate the 35,200 that we recorded as income less the amortization and reverse out the dividends. And remember, over here on the cost method, we still have to get rid of the dividends declared on the subsidiary, but our debit, instead of being the investment account, becomes dividend income. So hopefully that gives you a good overview of what happens between the three methods and how they differ. Pretty similar, minor differences, and it does have some effect on the worksheet. Now the real critical point is to understand that whatever happened in the general ledger is adjusted for on the worksheet. So when you get to the end product, the consolidated financial statements, they are going to be identical. There is no difference. The method the parent uses to record the investment is a moot point because we either record it in the general ledger or on the worksheet and we end up at the exact same endpoint. So hopefully that will help illustrate the parent aspect, and then we'll walk through 3 other exercises to see how this is incorporated into each method using a consolidation.